Central banks stand as monumental entities within global financial districts, serving as the backbone of the financial system. From Wall Street in New York to the City of London, these institutions are at the heart of economic activity. These institutions are not merely physical landmarks, but are pivotal in steering the economic destinies of countries. They are the unseen hands that guide the financial stability of nations. Often surrounded by iconic buildings and bustling economic activities, central banks are crucial in understanding the broader financial system. Their presence signifies the epicenter of economic decision-making. They function as guardians of economic stability, wielding tools that influence everything from inflation rates to employment levels. These tools include interest rate adjustments, open market operations, and reserve requirements. The power of central banks extends beyond borders, affecting global economic policies and financial markets. Their decisions can ripple through international trade, investment flows, and currency valuations. As regulators of money supply and overseers of monetary policy, they play a critical role in shaping the economic landscape. Their policies can either stimulate economic growth or rein in inflationary pressures. Their decisions can calm volatile markets or spur economic growth, making them key players in the global economy. In times of crisis, their actions can restore confidence and stability. This influence is crucial in times of economic uncertainty, where strategic interventions by central banks can avert financial disasters. Their ability to act swiftly and decisively is often the difference between economic recovery and prolonged recession. Central banks also serve as advisors to governments, providing expertise on economic management and financial stability. Their insights help shape fiscal policies and national economic strategies. This advisory role is complemented by their operational functions, such as managing national currency reserves and setting interest rates. These activities ensure the smooth functioning of the financial system. Through these activities, central banks not only support their own economies, but also contribute to global economic stability. Their coordinated efforts with other central banks can address global financial challenges. Their strategic actions often set precedents that are studied and potentially replicated across different nations. The policies they implement can become models for other countries facing similar economic issues. Understanding the essence of central banks is vital for anyone interested in the dynamics of modern economies. Their role is multifaceted, encompassing regulatory, advisory, and operational functions. In this essay, we will explore the definition, history, roles, and contemporary challenges of these powerful institutions. We will delve into how they have evolved over time and the impact they have had on the global financial landscape. By examining their evolution and operation, we can appreciate their significant impact on our daily lives and the global economy. Their influence is felt in every aspect of economic activity, from the prices we pay for goods to the interest rates on our loans. A central bank is fundamentally the authority responsible for the oversight of a country's monetary system, ensuring that the financial framework operates smoothly and efficiently. It is tasked with the management of its currency, which includes the issuance and regulation of money. It is the principal entity that issues currency, controls the nation's money supply, and regulates credit conditions, ensuring that the economy remains balanced and stable. These banks are often state-owned and operate with the primary goal of maintaining economic stability and fostering a stable financial environment, which is crucial for the overall health of the economy. The core functions include implementing monetary policies, managing exchange rates, controlling inflation, and supervising the banking sector, all of which are essential for economic stability. The role of central banks extends to being lenders of last resort, a critical function during financial crises. This means they provide financial backup to banks in distress, ensuring the stability of the financial system and preventing widespread economic fallout. They also hold and manage the country's foreign exchange and gold reserves, playing a crucial role in stabilizing the national economy against external shocks and fluctuations. This multifaceted role makes central banks a cornerstone in the architecture of any nation's economy, influencing everything from daily transactions to long-term financial planning and economic strategies. In addition to these functions, central banks often oversee the payment systems, ensuring smooth and efficient transaction processes, which are vital for the economy's day-to-day operations. They monitor the flow of money and credit, adjusting policies to foster economic growth or curb inflation as needed, responding to the dynamic needs of the economy. This regulation helps maintain public confidence in the financial system, which is essential for economic stability and the smooth functioning of financial markets. By managing interest rates, central banks influence borrowing and spending, steering the economy towards desired outcomes such as growth or stability. Understanding these functions provides a clear picture of the significant impact central banks have on a nation's economy, highlighting their importance in economic planning and policy making. They do not operate in isolation, but interact closely with governmental policies and global economic trends, adapting to changes and challenges in the global financial landscape. Their decisions and actions are fundamental to maintaining economic balance and promoting sustainable growth, ensuring that the economy remains resilient and robust in the face of various challenges. The concept of central banking can be traced back to medieval times, with institutions like the Taula de Canvi in Barcelona established in the early 15th century. This institution was a pioneering effort in public banking, setting the stage for future developments in the financial world. It was one of the first public banks to offer deposit and transfer services, providing a model for the essential functions that modern central banks would later adopt and expand upon. However, the modern central bank has its origins in the 17th century with the establishment of the Swedish Riksbank in 1668, which was created to stabilize the currency and provide loans to the government. This was followed by the Bank of England in 1694, which was initially established to fund the military efforts of the English government. These institutions were created to finance wars and manage state finances, evolving over time into the complex entities we know today. They began to take on more responsibilities, such as regulating the money supply and acting as lenders of last resort. The 19th century saw the proliferation of central banks in Europe, as nations recognized the benefits of having a central institution to manage their economies. This period marked a significant expansion in the role and influence of central banks. The Federal Reserve System was established in the United States in 1913, following a series of financial panics that highlighted the need for a central banking authority to oversee and stabilize the financial system. This marked a significant evolution in central banking, with the Fed designed to oversee and stabilize the American banking system. It introduced new mechanisms for managing the economy, such as open market operations and the discount rate. The 20th century witnessed the global spread of central banks, each adapting to the specific financial needs and political contexts of their countries. Central banks became crucial in managing national economies and responding to financial crises. The role of central banks expanded significantly during and after the Great Depression of the 1930s. They were instrumental in implementing monetary policies aimed at economic recovery and stability. Governments worldwide realized the importance of central banks in mitigating economic downturns and began to use them more actively to influence their economies. This period saw the development of new tools and strategies for economic management. This period also saw the beginning of closer cooperation among central banks to manage the global financial system, a trend that has continued to this day, with institutions like the Bank for International Settlements coordinating policies. This cooperation has been essential in addressing global financial challenges. The history of central banks is a testament to their adaptability and increasing importance in managing national and global economies. They have continuously evolved to meet the changing needs of the financial world. From their early days as financiers of state expenditures to their current role as guardians of economic stability, central banks have evolved into key institutions in the global financial architecture. Their ability to adapt and innovate has been crucial in maintaining economic stability and growth. The independence of central banks is a pivotal aspect of their operation, influencing their credibility and effectiveness in managing the economy. Independence ensures that central banks can make decisions based on economic data and trends rather than political pressures. This autonomy is crucial for maintaining investor confidence and stabilizing the financial system. It allows central banks to implement long-term strategies that may be politically unpopular but are necessary for economic health. The debate over central bank independence intensified in the late 20th century as countries increasingly recognized the detrimental effects of political interference in monetary policy. Economies with independent central banks generally experience lower inflation and more stable growth. This is because these banks can focus on controlling inflation and managing the money supply without succumbing to political demands for short-term economic boosts, which can lead to long-term economic problems. However, independence does not mean isolation. Central banks must still coordinate with governmental policies to ensure that their monetary policies align with fiscal strategies. This coordination is essential for comprehensive economic management and avoiding policy conflicts that could destabilize the economy. Moreover, while central banks are independent, they are also accountable. They must justify their decisions and policies to the public and legislative bodies, maintaining transparency and public trust. The balance between independence and accountability in central banking is delicate but essential. It ensures that central banks can operate effectively making decisions that sustain economic growth and stability while being responsive to public needs and government policies. This independence is a cornerstone of modern economic policy, reflecting a mature understanding of the complex dynamics that drive global economies today.